Good. It's 3 past the hour, ladies and gentlemen, and as a punctual German, I'm inclined to now open up our webinar. Welcome everybody, whether it's morning your time or afternoon or evening or maybe night. Welcome, great you're joining us to the Climate Bonds webinar on Euro Green Bond pricing dynamics in the first quarter. But we'll talk about more than that. We will talk primary and secondary market pricing. We will discuss anecdotes. We will discuss hard statistical evidence and all sorts of market vibes that we see on the sell side and on the buy side. You are looking forward to a great 60 minutes in front of us, and we will try to make that interactive as well. So there will be bits and pieces of presentation, of content, and then we will have rounds of discussion around that very content. Please feel free to ask any follow-up questions that you may have, and also in the interim via the Q&A section. We will monitor that and pick up questions as we go. Some may be answered in writing and some may be answered live or at a later stage, but we will do our best to answer at least some of them. So here we are today, and clearly we are in extraordinary times. We are in times of grave climate crisis with a unique opportunity in front of us, which is to build back a better world. And I will say I'm very delighted to be sitting here. You're seeing the background with this beautiful picture. I'm sitting in Rabobank offices, a great and long-term partner of the Climate Bond Initiative. And they've just hosted me. I had a pleasure to deliver a keynote speech on exactly those questions, climate crisis, and what can the financial markets do to help build back better. And we are the room was full of opportunity and excitement. Yes, there is the urgency. Yes, there is a crisis, but there's also a great moment in time and in history that we're having now to use this extraordinary low interest rate environment for a green recovery. And clearly part of that, and an important question indeed, is what's in it for us? What about pricing? How do markets price those things? How do markets price green? And we will look into exactly that. We have a great panel of speakers lined up for you today here. Ladies and gentlemen, we've got Sjoerd Humble from Obvion in the Treasury, and he's a special speaker. And he's a very special speaker today, not only because Obvion is part of the Rabobank group that I've just referred to, but also because Obvion again won the Climate Bonds Award for the big transactions and the RMBSs that they've done, dark green transactions that they've done over the past couple of years. So congrats for the Climate Bonds Award to Sjoerd and to Obvion in the Netherlands. We have François Millet from Lyxor, who have been a prominent player on the buy side in the last couple of years, contributing to passive investment development in the green space, and also a long-term partner of the Climate Bonds Initiative. And last but not least, clearly, Caroline Harrison, who's been pioneering our work here in the space for quite a few years now already, having done a series of 9 reports, would you believe, into green pricing. So go to our website and check the resources section if you want to read one or all of them. And indeed, mentioning our website, also keep an eye on our website for future webinars and past webinars, www.climatebonds.net/webinars, and monitor that for upcoming webinars. Please register there. We have a whole array of new themes coming up, and past webinars you've missed, no problem at all. You can watch all of them back. My name is Manuel Adamini. Been working with the Climate Bonds Initiative for the past 5 years, and it's been my pleasure today to moderate this great panel. Enough of that, and without much further ado, I hand over to you, Caroline, to take us through the initial set of your findings. There you go.
Thank you, Manuel. So I am Caroline Harrison. I'm a green bond analyst at Climate Bonds Initiative in London. And my focus is green bonds and how they behave in the markets compared to vanilla equivalents. So I'd like to start off with a brief recap of what happened in the first few months of 2020. But first of all, I need to figure out how to move the slides.
Take your time.
Okay, so the coronavirus outbreak is the first bond market shock that we've had since the green bond market sort of materialised to a reasonable level. And the market has not been tested in this way yet. So this is our first opportunity really to determine how investors under pressure treated their exposure to green bonds. So towards the end of February and going into March, the bond markets, as we all know, seized up dramatically. Issuance slowed down. But by late March, central banks had stepped in to support the market and give some boost to credit. So some of the planned green bonds that we had expected to come to the market got delayed until later in the year. With the uncertainty in the market, it seems that organisations obviously preferred to maintain the flexibility of a non-labelled bond where they could use the proceeds where they were needed the most. So we have noted in our market blogs that measures to support the green recovery from the pandemic have materialised in several jurisdictions so far. So, for example, companies in Canada have to disclose climate impacts in order to qualify for COVID-19 relief. I think Norway has proposed a package to support green technology products. Germany has announced a set of green recovery measures, including support for electric vehicles and R&D on green hydrogen, among others. And the EU recovery package will also have a huge green component. The results of our Treasurer survey that we published in March this year indicated that issuers wanted to issue more green bonds. So Treasurer said, we want to bring more green bonds to the market, we want to repeat issue. But a few of them actually noted that what was stopping them was a lack of available projects within the real economy. So we expect governments now to seize this opportunity and develop their economies in a resilient and sustainable way. And we hope that this will be the catalyst for a greater focus on green development. So I'm just going to briefly talk about how green bonds have performed against vanilla equivalents in the first half of the year. So many of you will have seen this chart many times over the last month or two. I have seen this chart lots of times. And the discussion that we're going to have from now on will focus mostly on euro-denominated credit, because that is where the greatest number of benchmark issues with sufficient data is available to enable us to make comparisons about this market. So this slide shows the swap spreads of two Barclays euro-denominated bond indices, corporate bond indices. So one of them only includes green bonds, and that is the one that I have coloured in green. So the green bond index is tighter than the broad market index, and sometimes the difference between the two extends above sort of 25 basis points. So it is quite considerable. And if we only looked at this chart, we could assume that green bonds have performed much better than non-green bonds in the crisis, based only on this metric. And I've read some research that says that that is the case, but there's a bit more to this story. So in the next slide, I want to emphasize the importance of making correct comparisons. So on the left-hand side of the screen, you can see a picture of an orange and an apple. We all know what they are. They are both in the category of spherical fruits. But when you take the skin off and you squeeze them, you will find that they are very different. One will give you a lot more juice because the cellular structure of an orange is different from that of an apple. And that is basically the crux of this discussion. Likewise, you know, we can't draw conclusions for comparing a broad market index with a green bond index because they are structurally just too different to enable that to be credible. So the duration of these two indices is fairly similar. So that's the penultimate sort of detail that I've put on here. But when you look at the sectoral composition, you can see that they're just completely different. So the energy sector took a decent beating in the first part of this year. And the green bond index has absolutely no exposure to that sector or, for example, airlines. So, of course, as one would expect, the spreads were indeed tighter. The number of bonds is also an influential factor. So 3,029 bonds is a huge, huge number of securities, and 3,029 bonds do not trade every day, which means that the calculations use matrix pricing, theoretical pricing, and unfortunately, those methods of pricing do not always capture market movements. So meanwhile, the green bonds will be newer, and perhaps the pricing observations might be more accurate. We'll come on to that in a second. And finally, the regular bond index, so the broad market Euro aggregate corporate index, does not exclude green bonds. So green bonds are included in both of these indices. And in comparing the two, we really don't know whether we're coming or going. So it's much better to leave this aside and look at more micro comparisons. So if we are trying to isolate the element of the performance that is attributable to the greenness of the bond, it is better to look at individual bonds. So here we are looking at benchmark size, euro-denominated utility bonds issued throughout 2019. And I have charted them next to vanilla euro-denominated utility bonds, also issued in 2019. So utilities is quite a good sector for us to look at for this type of comparison, because there are a decent number of green bonds from a range of issuers and also a similar number of non-green bonds. So the x-axis here is the duration and the y-axis is the z-score. So we've simply measured the z-score over a 1 month period, which includes the period to the 24th of March, which is when the Federal Reserve and the ECB started to become active. We've simply measured the z-score over that period to see where the spreads end up compared to where they started. So what happened during this sell-off? Utilities is a defensive sector, but we can see here that all the bonds sold off. So if we look at the BBB rated bonds on the right-hand side of the screen, we can see that they are sort of, the green dots are sort of clustered towards the lower part of the chart, which suggests a less aggressive sell-off was recorded by the data, while the single A chart on the left-hand side is more of a mixture. So critically, during the period when the market activity ceased, we know that to some extent the green bond market did remain open, and investors were able to find buyers for green bonds, which they were then able to sell and perhaps roll the proceeds into new issuance green bonds, or to fund redemptions. So to further explore how greenness has contributed to performance, I just want to look at one more slide, and I've built some yield curves for Iberdrola, which I love looking at because there are a lot of green and non-green bonds. So Iberdrola is a European utility company. It has a clearly defined and very publicly stated transition strategy. The company has a target to have virtually zero emissions in Europe by 2030 and to become carbon neutral by 2050. So almost half of the bonds have a stated green use of proceeds, and they're the green dots on these charts that you can see here. And those proceeds are used exclusively for renewable energy. So in chart 1, we can see that the green and the vanilla curve are intertwined. So this chart is a snapshot of the yield on the y-axis, and on the x-axis the duration. So this is from the 24th of February, just before sort of the market closed down. And we can see that the curves are intertwined, which is what we would expect from a company with a good transition strategy, because when investors buy a bond from Iberdrola, they are buying into you know, what they perceive to be a well-run green organisation. And so as the market sold off, which is chart 2, we can see that the green bond curve actually moved outside the vanilla curve. And this could well be to do with valuations, which are always really, really difficult to make in a closed market, but also because if investors need to return cash to investors, well, what will they sell? They'll sell their most liquid bonds first, of course. And as we've already said, the green bond market was much more tradable compared to the non-green market during these turbulent weeks. So towards the end of April, things started to settle down. And by the end of June, the green bond curve is in some parts trading inside the vanilla curve, which shows that there is confidence in the green bond market. So perhaps having covered those slides and made those remarks, we could bring in the views of some of the panel members on these topics before we move to a discussion about the relative volatility of green bonds.
And before we do, Caroline, and thank you for this great presentation. This is really interesting stuff. But before we do, I do have to make an apology to our panelists and specifically to Ulf. I was stupid enough or rude enough not to introduce one of our great panelists, a very smart and outspoken mind, which is Ulf Ollerson. Some of you may remember him from his time at the AP Funds, now CIO at DM Credit. Ulf, apologies for not having introduced you, which means you get the first question. Can you help us make sense of what Caroline has presented? You're an investor, so are green bonds a better investment? Yes or no? Just make it simple. This is all so complicated. Tell us, is it a better investment?
Yes, I think so, but that's from a normative statement. It's not always you can find the evidence in the data, and we'll discuss that a little bit later on, but Karin is making some very good points on that. They look good, but it hasn't given us definitive evidence just yet, even in the COVID crisis, that they outperform.
But why is that? Tell us more.
I mean, you can even look at something that was really well defined as the Iberdrola curve, as highlighted here, and it's pretty clear when you look at it from an almost statistical standpoint that we just have too few data points sometimes to actually isolate the outperformance or lack of outperformance of greens versus traditional bonds. But I think it doesn't need to be a big issue. There are other sort of parameters playing why you would be buying a green bond. But sometimes you can make clear statistical evidence, and I'll come back to that a little bit later on.
I know, we know you've done an awful lot of research there. We will discuss part of that. But, in the end, this is all about, are green bonds more stable in a very volatile market environment? I think the presumption had been, yes, they could be because investors buy that stuff because it's green. Caroline, you've just alluded to the fact, well, maybe it's the other way around, and it's exactly those instruments are being sold off, not because they're green, but because they come from highly liquid issuers. So what is it now? Better or not? Caroline.
What do you mean? Sorry.
Yeah, so is it a better investment in times of market volatility? Does it help me? Will prices remain very stable because investors do not sell it off because they bought it for the green in the first place? Or does it work to the contrary? Investors do sell it off because that's the liquid stuff highly rated.
Well, I think as an investor, I mean, I'm not an investor, as you know, but I think what investors need to do is to be able to maintain flexibility and remain nimble, particularly in a falling market. And if the market shuts down, but the green portion of the market remains open and I as an investor own green bonds, then that puts me in the ultimate position of flexibility, right? Because I've got the option to liquidate my portfolio at reasonable prices if I choose to do so.
And how did that work out for your clients, Francois, in the passive product? What did you see happen?
Well, first, the passive products are just bound to buy in the secondary market, of course, so they are not participating to the primary issues. Well, on the last CBI study, what I noticed is that even the previous study where we're highlighting a moderate green bond pricing advantage for the issuer, which is not the case anymore when we see that I think it's 22% in euro or only 14% in dollar have a greenium, so that's nothing. There has been a sort of a greenium legend which built up with a few studies in 2017 in particular, but it's clear that even the technical expert group in Europe has shown that there is inconclusive analysis on the existence of greenium. Everything is confirmed. There has been no less than 3 studies from the European Union, the Research Center of the TEG and one for the Commission. So there is some of the results are heterogeneous, but on the primary market, it seems to be very much in line with the last conclusions of the CBI study. Ourselves, we deal with index products. So the green bonds need to be screened for eligibility to belong to the universe of the index, and we buy only the green bonds something like 2 to 3 months after the issuance dates, which in a way is after the distortions of the primary market are settling down. So your study is perfectly showing not only the narrowing, the tightening of the spreads during the book building process, but also after 28 days. And I would say that when we are buying green bonds for indices, we are buying the liquid segment of the market, and we are buying these bonds after all these primary distortions have settled down. Generally.
Okay, we're getting the question, by the way, Francois, whether you could speak up a little, maybe get closer to the microphone. But what I would be keen to hear will be, I mean, evidently in a passive product, you're more constrained. I appreciate that, and active managers may have more degrees of freedom. But clearly, performance is driven by what prices are doing, and that's driven by flows of money. What I have heard a lot in the market is that at least the flows into and out of green investment products, whether they're active or passive funds, have been much more stable throughout the crisis. I've seen many investment managers report to me on a more anecdotal bias saying, well, even during the depth of the crisis, we saw reasonably limited outflows because the clients that want to buy green paper come there for the green, so they prefer to stick with it and sell off other parts of their portfolios before that, which would be supportive, evidently. What have you seen in terms of client flows in your passive product, Francois?
Yes, well, the ETF market is a very good proxy of flows in the overall market. It's a sort of advanced indicator of what's happening everywhere in active management, in index funds and so on. Exactly. What we saw is that from the end of February to the end of March, there has been massive outflows from European ETFs, something like 35 billion of euros of outflows. That was not the case for ESG products. ESG products continued to gather 2 billion of net new assets during the critical period. And as far as we are concerned, and in our experience of the green bond ETF, there has not been a single seller in the critical period. It's in a way a paradox, because people like the idea to subscribe in a liquid product like an ETF, for example, for the sentiment they could get rid of their position in case of emergency. But that was not the case in March or April at all. We even had a few more subscriptions during the period. So the very strong resilience of flows to ESG products globally was extremely outstanding. And the one on green bonds, if I compare to the outflows we had for corporate investment grade and corporate high yield ETFs, which were massive in the period, is very different. So it's a sign that there is by nature a buy and hold clientele for green bonds. So it's located in more stable pockets of the portfolios, definitely, as compared to other kind of products, of passive products.
I mean, that is pretty big news, Francois, saying that even at the height of the crisis, or the depth, if you want to, there was not a single outflow. I mean, that is pretty serious support from your client base. Congratulations for that. That's really great. What do all of these moves, as we've discussed them, what does that mean for your outstanding paper? What have you seen?
Hey, thank you, Manuel, for your question. Maybe to start with a very short background on Opvion for maybe the viewers that don't know us that well. We're a 100% daughter of Rabobank, and we're focused on originating mortgages in the Netherlands via the intermediary channels. The intermediary channels for mortgage origination is the most frequently used way to do that in the Netherlands. We are a very established prime European securitization issuer. And in 2016, we also started a green securitization program where we've issued 4 tranches from so far. So I'll be focused more on the Netherlands mortgages and mortgage-backed paper.
Fair enough.
And to come back to your question, what have we seen in this very short sell-off period? No difference at all between green and normal paper. We see everything performing in the same way. And I think one of the big reasons what we see for our paper, but for also comparable paper, is that everything is eligible for purchase programs within the European Central Bank. The European Central Bank is putting a lot of money in the system, not dedicated for green, but for everything. What we see as well is primarily, I think our entire investor base is not only the green one, but also the normal investor base is primarily buy and hold. So that has an impact as well. But a positive one on green is that because the collateral for green transactions is more scarce, the transactions are a bit smaller in volume. Smaller could mean less liquidity, but despite that, we're not seeing a difference in behavior from investors, and I think that's already a positive. But to wrap it up, right now, no difference between green and non-green pricing.
And I saw you react there, Caroline. I'm evidently Albion is one issuer with a few nice outstanding green transactions now and green RMBS. But you've seen so many more. How does that resonate with you, Caroline, and all the research you've been doing over the past couple of years? You're muted.
Sorry. In the primary markets in general, what we've seen from the research that we've done is that green bonds do tend to, in general, achieve higher book cover and experience greater spread compression compared to vanilla equivalents. We've also seen that in the immediate secondary market, they also tend to tighten more after 7 and 28 days. So these metrics are something that we have observed over a long time period. I would agree with the comments that Sjoerd made that when it comes to selling off is selling off. And part of the reason for this is the data. And I think that this is something that people do not talk about enough. You know, yes, all bonds appear to have sold off, and there doesn't appear to have been a great difference during the period when the market seized up. But it's very hard to actually read anything from that data, because how can you make prices for bonds when there's no market? You know, how can you create data when there's nothing to create data from? It's just invented numbers, and we do our best to try to pull out meaningful stories from this. But really, you know, the period February, March, and even sort of early April, there was, you know, it was very, very hard, I imagine, to price for data providers to actually get data for bonds to determine how they were behaving, because there just was no very, very limited amount of activity. So I think that's something that should be emphasized here, you know, as part of the broader discussion.
And abstracting from that specific, although very interesting period for a second, I mean, the question we're facing here, and discussed with the bankers at Rabobank here today as well, is there greenium, yes or no? The question would be, does it matter? I mean, please do react to that, both the investors on the panel and the issuer. Does it matter whether there's one? I mean, there's so much discussion about it, so much fuss. Is it worth it?
Yeah, maybe I can take it from an issuer side, and I think Ulf already said there are very good other reasons for issuing or investing in green bonds than just the greenium, and we're talking about it a lot. And yes, it would be helpful for us if there would be a more favorable pricing for green bonds, because then we could use that in our client pricing to persuade our clients into becoming more sustainable and benefiting from it as well. So we always hope that it will be there, but it's not for us. There's never been an important factor in choosing to establish a green bond program, and I don't think that this should be an important factor. We've always done this to provide green investment opportunities for green investors. And we also, as an issuer, see a lot of benefits from having such a program, and that way being able to show as well what you as a company are doing to make this world a better and more sustainable place.
So there's so much more to be done. Any reflections, Ulf, François? Ulf, maybe go first.
Yeah, no, I mean, from the investor perspective, the premium is extremely important. It's only a limited set of investors out there who are allowed to actually sort of subsidize an investment that is good by actually, getting a lower return or yield bogey on that investment. So if we see outsized sort of greeniums, we have to go back to our end investors, our end users that we're managing money for, and say, this is how much we're paying up in order to go green. So there's this natural sort of, if I compare to the issuer side, we have this natural conflict. Obviously, the issuers want to issue as cheaply as possible. We want, to get the product at the same price or better than traditional product. And that's I think there is an offset there where we can argue that green bonds are lesser risk, have lower volatility, and hence they can come at a tighter spread, but they are also sort of fiduciary investments for us on the end investor side. I'll come back a little bit to that later on, but just the pure outright greenium spread argument is a little bit dangerous for the investment, for the green investment market to grow with traditional investors.
So it does matter for your constituency, heavily indeed. Francois, any reflections on that?
Yes, well, on the greenium and the greenium going forward, what is still striking me is that there is no real significant greenium information, while there is a structural imbalance in the market, which everyone is agreeing upon, which is a sort of contradiction as well, because we know that the ECB, Mrs. Lagarde has repeated that they have bought 20% of the eligible green bonds. The primary market has just stalled, so it has been frozen because of the COVID crisis. So hopefully it will recover very soon because there is a queue of issuances. But the main issue is the imbalance between the demand and the offer, which we see in the crisis because there is no real seller in the market. There are more buyers than sellers in the secondary market as well. The real issue is the pipeline, the pipeline of new projects and new assets to be financed, which is still too short. And the question is, what sort of incentive do we need to bring more issuers to feed this pipeline with additional projects and additional assets, which we desperately need to finance transition? Is it a greenium? Is it the perspective of having a lower yield to maturity on the issuance that would be the incentive, or are there other kind of incentives we should rely upon for pushing issuers to feed this pipeline? This is my worry for the future. There is no market where there is an imbalance between offer and demand, which is not reflected in the pricing. And it's a bit, if it is a case right now for green bonds, just because at the end of the day, whether it's green or non-green, these are the financial properties and the final risk profile of the issuer, which matters for the subscribers, and not only the use of proceeds.
Let me pick up that term, Francois, before we go to the next couple of slides. Caroline, you've explicitly flagged Iberdrola and their well-defined transition strategy. Does the market, or does it not, price the transition strategy here? Is there anything sensible we can say about that?
Well, what I can see from looking at these yield curves is, and as Ulf pointed out, yes, the data points are not identical in that the maturities are not identical, so it is not a perfect match. But the fact that the two curves are closely intertwined suggests that investors consider Iberdrola to have a strategy in place that they understand. And I think it was NatWest Markets that did some research on the green halo effect that suggests that when an organisation issues a green bond, it actually brings down the rest of the yield curve because investors perceive that company to have this well-defined transition strategy in place. So, this is one of the things that came out of the Treasurer survey that we published earlier this year as well. And so many things came out of that survey, as you know, Manuel. But, one of the things that Treasurer said was that it was issuing a green bond was an opportunity for them to kind of manifest, if you like, the transition strategy that they had and the way that they were thinking about becoming having sort of this well thought through methodology for greening their revenues, and the green bond was the ultimate sort of expression of that, and the ultimate way of communicating that to the market. So that was something that a lot of treasurers mentioned.
Like Treasury driving strategy development there. Yeah, I mean, you wanted to come in, Rolf, before we go ahead?
Yeah, I'm just gonna, the view from the trenches with regards to, issuing green bonds and getting the traction with investors, etc. I mean, if you go on a roadshow in Europe today, the difference between doing it with a green bond and the number of meetings you will get as an issuer compared to if you do it with a sort of non-green type of roadshow, I think it's very material. You'll see in Scandinavia, for example, a lot of issuers wouldn't get meetings at all unless they come with something green today. So it is a very good way to sort of broaden the investor base and get your name much more well known out in the marketplace.
Sure. Well, I see Caroline and should nod there. Shall we go ahead, guys, with the next couple of slides where we go into a few more technicalities there? Would that be okay? To go ahead, Caroline.
Okay, so the next few slides, Ulf, you are going to talk about the work you've done here on volatility in the secondary market. So I'm going to move the slides on, so just give me a nod.
Yeah, please. Okay, so the discussion here has been a lot around the green bond premium, and that's almost like an eternal discussion. I've been in the market since pretty much when it started out in 2013, when it started out for real, and we've always been discussing the same thing. So post-COVID now, a month back, I wrote a paper where I tried to sort of think about the green bond premium, but also the green bond risk premium. So what is the green bond spread that we get extra less, but we still have volatility. So a good argument for green bonds, it will be, diversified investor base, etc., and hence volatility should be lower. That's actually fairly straightforward to test, or straightforward, but it's something where you can actually do some proper econometrics on it. There's a link to the paper on SSRN network. I'll also post that on the chat. And you take the next slide, please, Carolyn. So just to give this a little bit sort of a finance backdrop, how can we actually look at the risk premium in green bonds? We can look at this from a traditional model portfolio perspective. So we assume in this case we have two different bonds, one green and one traditional bond. They have expected returns 4% and 5% respectively. And then they have different volatilities, so 2% and 2.5%. And that gives you the sort of the Markowitz bullets that you see on the left-hand side there. So traditional portfolio theory, that if you combine a portfolio of those two, you can have something which has a better sort of Sharpe ratio, or higher risk-return ratio than if you only hold one of the assets in isolation. And that's being illustrated on the right-hand side, where the horizontal axis shows you the percentage in a portfolio you allocate to the traditional asset, and then what sort of Sharpe ratio you get out in that case. So if you optimize a portfolio of those two assets I mentioned, you will find that the optimal portfolio solution will be where you have 56% of the green bond and 44% of the traditional bond, and that Sharpe ratio coming out for that will be 2.58. Now, how does this help us? Well, it actually helps us in a way that I'll show on the next slide, please, Carolyn. So what you can do is to say that, okay, I assume that my green bond has this lower volatility, and I'm sort of decently better in shape of measuring the relatively lower volatility of the green bond. But given different relative volatility numbers, can I derive what the actual risk a green bond premium should be? And that's being highlighted here in this graph, where we see that, in order for us to be neutral between the green and the traditional bond, i.e. where we have a 50-50 portfolio, the return on the green bond based on that 2% volatility number should be 3.45%. And in this case, which is a very sort of contrasted case, we would say that the 3.45 versus the 5% gives us 155 basis points, or 1.55% spread differential. That's based on the volatility that we see in the market. So here we see something that, you know, if we can measure relative volatility between a traditional and a green bond, we can actually say quite a lot, given some correlation assumptions as well. We'll take that to the next slide, where we actually start looking at a couple of these cases. So I've looked at the green bond market quite thoroughly, I think, and it's very hard to pinpoint good sort of twin bonds in the marketplace. And funnily enough, the Uni-Baylor of Damco case is probably the case where we have the best sort of identical, structurally identical type of bond. So if you ever want to go somewhere where you have almost two very similar bonds, the ULFP, and you know the corporate ticker is sort of fun for someone's called Ulf. That's the only time I have anything fun with my name. But those two bonds, the 0.78 Feb 21 and the ULFP 1% March 25 bond, those two bonds are almost identical in structure. And you can see the spread graph and sort of trying to drive a green bond premium in there. Now, what's really interesting, and it's hard to see here, but we do the econometrics around it in the paper, is that actually we find that the green bond has slightly lower volatility than the traditional bond, which comes out really in this COVID-19 market volatility. So that would, in this case, actually motivate a slight premium, a 3.4% premium in the Uni-Baylor Damco case. But this is individual for a bond, So if we switch to the next slide, we see an opposite case where we look at European Investment Bank bonds. You know, they have been very big issuers and sort of almost work as the cash equivalent in the green bond market. And if you do some of this analysis, and it's thoroughly done in the paper, you can find that actually some of the EIB climate awareness bonds were underperforming quite drastically, both in volatility terms, but also in spread terms vis-a-vis the traditional bonds during the COVID-19 volatility. And we can discuss that more why the reasons are, but I think it is one of those effects of green bond funds. When they need to sell, the asset they have to sell will be the EIB CAB bonds, and hence those bonds are actually should almost like attract a slightly less of a premium because they become cash equivalent in some ways.
Okay, this was a great presentation. I reckon we may have technical people in the audience, we may have less technical people. Can you just try to summarize it all again for a layman audience in 3 sentences? Or what have we learned from this?
So what I think the audience should learn here, and especially issuers, is you should push and maybe make arguments for why your green bond issuance, or your green bonds coming out, will have lower volatility than the traditional bonds. Because that's a great argument for the investors then to say, well, I'm buying this green bond, it has slightly lower spread, but it also have much lower volatility. So from a risk return perspective, which is my fiduciary duty, I can actually buy it. And hence the issuer can actually get the lower spread as well, lower cost of capital. So there is this volatility trade-off that could go on.
Well, then the salient question is it then lower risk because it's green, or does it just happen to have lower risk because of other characteristics? I mean, that's the $1 million question, isn't it?
Well, both yes and no, I'd say. Sometimes I'm just a bond trader, and if I see something has a lower volatility but a slightly higher return or a more attractive risk return ratio, then the market is pricing that wrong, and I tend to buy that type of asset. And I don't need to think that much about the basic motivation. Of course, I buy some of the arguments you're making to it, but sometimes we shouldn't make this too complicated either. If green bonds are better sort of risk-adjusted investments, then just buy them.
That's a good sales pitch, Ulf. That's a good sales pitch. Any reactions from the panelists?
Yeah, sorry, can I just interject and say that this argument is particularly pertinent for emerging market issuers because they need some incentive to label the bond as green. And investors, as we discovered as part of our investor survey, are very keen to buy more paper in emerging markets. So what you get as an issuer, as Ulf pointed out, is you attract this new investor base. You may pay a slightly lower yield to your investors, but at the same time you will also get lower volatility, which any emerging market investor will value. So this is decent value add for emerging market issuers.
And let me pick up that thread, Caroline, because I note on the Q&A section we've had a couple of questions about other paper than, you know, the largely highly rated Euro paper we've been focusing on for various sorts of methodological and sample size reasons in the studies. But we've had a couple of questions like, can we say anything about, you've now touched upon emerging markets. There's also been questions, can we say anything about non-rated, about other than Euro denominated, about Sukuk maybe? Anything you, Caroline, or the panel knows about those things so we can help out those that ask the questions on the Q&A?
Want to have a go? Does anyone else want to have a go, or I can?
Give the gentleman some time to think.
Yeah, okay. I mean, I was just going to say that in terms of making observations about the market as a whole, it is very difficult to do in other markets because there is not really a critical mass of green bonds that share common features. One thing that I would say is that if you are issuing a green Sukuk, you will have an additional source of investment demand. So obviously if you are issuing a Sukuk, you will have those investors buying that Sukuk because it is a Sukuk and that is part of their mandate. And then if you add the green element, you will have those investors who are buying it because it's green, because that's part of their mandate. And then you'll have more investors that are buying the bond because it's a bond and they need to buy a bond on that day. So you just attract more demand the more you layer on these sort of speciality factors. But then I mean, you probably shouldn't short an investment like that, right? Because you'll never be able to buy it back in the market. But it just makes the security more unique. And in fact, where we had the one bond, I mean, I'm just doing the workup right now for the first half of this year and looking at the large bonds that have been issued. And the $1 bond where I did note that there was a greenium was the Indonesian government bond, which was also a Sukuk. So that bond came very clearly inside its own yield curve, and that's the only one that I found so far in the first half of this year that has done that.
Any clue why that happened? Why that was?
Well, I think it's just the additional sources of demand, you know, and also, of course, investors want yield, right? There's no yield anywhere, so they have to move down to perhaps, if they're mandated to do so, if they're able to, emerging market paper makes more sense because it gives more yield.
Sure, I think you wanted to come in.
Yeah, I definitely agree with Caroline that factors like this are very important for issuers, for instance, emerging markets, more than what I see very, very established markets where we are in. What is an important factor for us, and then I'll pick it up what Francois already said, the supply and demand imbalance that is already there. There is a lot of demand for green bonds, but at this point in time, there's also a lot of demand for non-green bonds. There's an imbalance on every single asset right now, particularly because of the ECB policy on that front. Looking forward, I think for us as an established originator, regulation is an important factor that could create an even bigger supply, a bigger demand for green compared to non-green assets, and that factor is for us important. One of the first things we'll have that's very interesting on that front is the new EU green bond standards and the green bond taxonomy and the reporting, which investors will mandatory have to do as of next year. So it will be very visible for everybody where you invest in and how much do you invest in green. That can already boost the demand from the investor side in green and have a positive impact on the green market as well. If you then move that even further on and look into green supporting factors where the European Commission is looking at more favorable risk treatment for green assets, or maybe the other way around, penalties for non-green assets, that could even further increase the amount of demand for green paper, and really help the market both in persuading issuers to tap into the green market, but also in terms of greenium. So in short, I definitely agree with the other speakers that there is other important factors as well. For us, an interesting one is regulation.
Yeah, and mind you, I mean, you've referred to the ECB a couple of times today. But for those who've read the headlines in the Financial Times this morning, you might have noted that Christine Lagarde has made a very forceful point. One of the initial conclusions coming out of the pending strategic review of the ECB, isn't it? But they have indeed said there will be much more focus on climate risks in the bond buying programs by the ECB, and I think so. This guerrilla buyer will even become much bigger within the green space. So I think that is pretty big news. Conscious of time, ladies and gentlemen, I would suggest we move to the last part, Caroline, which is just let's spend a few minutes on the special role that ETFs have here. Evidently, passive investment has grown very, very significantly over the last couple of years, including in the green space. And let's make some remarks. Let's have a quick look, and then also do a bit of an outlook in how this may play out further in future. Over to you, Caroline.
So just to wrap up a couple of points that Sjoerd and Francois have already touched upon.
That will be good.
We expect the demand for green bonds to grow. We expect the demand for green bonds to continue to grow. There's been an increased emphasis on sustainable investment throughout the COVID-19 crisis, and we expect more money to flow into these strategies, including green bonds. So the growth in ETF, green ETF, is a very good way to monitor this because the information is public and it's comparable and it's updated frequently. So while we don't have access to the size of green bond funds and how they're moving up and down, we do have access to ETFs. So that's a very good proxy for us to look at the market. So the growth in the size of these funds since December 2019, particularly in the Lixor Green Bond DR UCITS ETF, which is in Francois' stable, suggests that more money is indeed flowing into this space, as Francois has already confirmed. And considering that this category of investment strategy, this category of investment requires the green label, you know, if you're going to be included in a green ETF, you need to be a green bond. So we expect this to put even more demand pressure on the market. So that's just to emphasize a message that has already been delivered in other parts of this conversation. So just to round up, the several sources of support for the market. Participants in our investor survey highlighted a shortage of all types of green bonds. So the 48 investors that we talked to all said that they wanted to buy more green bonds. So we know that people want to buy more green bonds. Added pressure is coming from the ECB, which we've also already mentioned, and of course the growth in ETF. So just to give you a slight hint of some of the, you know, as I said, I'm doing the workup now for the first half of this year, and what we found is that ordinarily 50% of green bonds get placed with investors that describe themselves as green, and in the first half of this year that number has risen to 60%. So the appetite from green investors has increased, and evidently issuers and syndicate desks are willing to allocate a greater proportion of those bonds to green investors. And as I've already said, there was no evidence of agreenium really in the first half of this year, as one would expect given the market conditions. But we have seen a normal number of benchmark size green bonds issued in both euros and dollars in the first half of this year. So although the market has been up and down in terms of flow of new issues, overall the first half of this year we've seen the same number of benchmark sizes. And then in the chart below I've just highlighted some of the sort of more remarkable numbers that we've seen from some green bond issuers in the second quarter really of this year, particularly you know, Iberdrola, EDP, Swisscom, and the Prologis Finance at the bottom. So we have seen, yeah, we've seen some remarkable pricing dynamics in the green bond market, and we expect, as Francois has said, as Sjoerd said, and as Ulf said, the demand dynamics to become even more pressurized moving forwards.
Great stuff. Guys, we've got 3 more minutes. So let me phrase this as a question. Positive recovery for green bonds, question mark. Please, everyone, short and sweet answer as a parting thought and to hopefully end on a positive note for this webinar. Give us your hunch, give us your estimate. Will there be a positive recovery for green bonds going forward? Let me start with you, Sjoerd. Give us your parting thoughts.
Yes, definitely. And there is way more to come.
That was short and sweet and very positive. Ulf.
I think it's possible, but we need to keep it the market still. Getting too many of policymakers into the market and sort of breaking it will potentially give a worse engagement dynamic in the green bond side, which sort of worries me.
Worries, but positive or negative?
Oh no, I think positive on the green bond market in general. That's definitely.
So positive with a caveat. Well, you're a researcher after all. You got to be cautious. Francois, over to you.
Yes, I think, well, in this big transformation of investment towards more ESG-oriented strategies, the green bond market is certainly the one which has the highest level of standardization through the taxonomies, the standards, including your standards and taxonomy, of course, and it brings clarity to the market. And there's definitely a very strong aspiration for putting more green bond products in the portfolios of investors, having in mind that we discussed private placement and emerging market, well, green bonds, but liquidity will be very important. We believe that liquidity will bring scale, because this is where you can have a chance to shift the trillions and attract the big money. So working on, you know, fungible issuances, repeat issuers, larger issuances and so on will be very important. And the role of passive as well will be important, because as the regulator is showing with the climate benchmarks and the Paris Align and the EU climate transition benchmarks for corporate bonds and for equities as well, the regulator itself is believing in the capacity of benchmarks precisely to bring transparency and clarity. And I think this will happen also in the green bond area with the taxonomies and all the developments to come.
Fantastic. And Evelyn, you helped to bring in that liquidity with your passive product, isn't it? And you guys must be doing something very right there, given your growth, the growth you've seen in your product. So congratulations for that. Ladies first, ladies last. Caroline, you've told us your thoughts as a researcher. Give us your personal hunch about positive recovery for green bonds.
Okay, I won't beat around the bush. I'm going to say governments, come on, step up, get involved. Try to, you're not going to probably meet your targets set in the Paris Agreement, but make an effort to get there and use green bonds to do that. Build a demonstration market, give investors an opportunity to have large liquid products to start off their investment portfolios in this space, and encourage other issuers to get involved in the market. Leadership by example. Come on, you can do it.
Couldn't have said it any better, so I won't dare trying to add anything to that. Thank you very much, Caroline. We're there. This has been a fantastic and very fast-moving 60 minutes, at least to me. The time really does fly. We're now 1 past the hour, so we got to wrap up very quickly. Just a big word of thank you to all of you, to Sjoerd, to Ulf, to Francois, to Caroline for this webinar. It was great discussing with you, great research and nice opportunity. We have seen a very loyal and stable number of participants dialed in, a large number, and it remained large all the time through. So that was really great. Thanks to the audience. I also wanted to say a wholehearted thanks to our communications team behind this, guys. This wouldn't be able without very smart people doing the logistics and the abracadabra about the technology behind this. So thank you, Louisa, Mari, Lena, Andrew. I hope I haven't forgotten anyone at the CBI comms team. And then the audience, please feel invited to our next series of webinars. It's been going on for a couple of weeks. It keeps going on. So just check out climatebonds.net/webinars for either recordings of past events or for announcements of future events. Make sure you're dialed in. Thank you very much, and hopefully see you again soon. Bye.